What's going on, everyone? My name is John with Valiant Mortar, and I'm an economist. Today, we're talking where to keep cash. If you watched our last video, you know that keeping a solid cash buffer is the absolute foundation of financial security before you start picking individual stocks. But once you got that cash, you can't just let it sit under a mattress in a traditional checking account earning 0.01% interest. That's a losing battle against inflation. You gotta make sure your money's working for you, even when it's sitting in the sidelines. Hit that subscribe button right now if you want clear, data-driven strategies to preserve and grow your hard-earned capital. Today, we're putting the three heavy hitters of short-term cash management head-to-head: high yield savings account, money market funds, and US Treasury bills. We're going to break down the mechanics, the risks, the liquidity, and the hidden tax advantages so you know exactly where your money belongs. Let's start with the most common option, the high yield savings account, or HYSA. Think of a high yield savings account as a regular savings account on steroids. It works exactly like the account you have at your local brick and mortar bank, but is typically offered by online only financial institutions that don't have the heavy overhead costs of physical branches. Because they save money on real estate and tellers, they pass those savings on to you in the form of a much higher interest rate. The biggest benefit here is absolute simplicity and safety. High yield savings accounts are backed by FDIC insurance for up to $250,000 per depositor, per institution. That means even if the bank goes completely under, the federal government of the US guarantees you'll get your money back. In terms of liquidity, which just means how quickly and easily you can turn an asset into cold, hard, spendable cash, high-yield savings accounts are incredibly convenient. You can usually link them straight to your checking account and move money back and forth within 1 to 2 business days. It's an excellent home for basic emergency fund because it's completely frictionless. Next up, we have the money market fund, or MMF. Now, don't confuse a money market fund with a money market account at a traditional bank. A money market fund is actually a type of mutual fund that lives inside a brokerage account where you invest your money in stocks. When you put cash into a money market fund, you're buying shares of a fund that invests exclusively in ultra short-term, high-quality debt securities. We're talking about things like short-term government debt and commercial paper issued by massive, highly stable corporations. Because they invest in these premium short-term assets, money market funds often offer a slightly higher yield than standard high-yield savings accounts. But there's a structural trade-off you need to understand. Unlike a high-yield savings account, a money market fund is not FDIC insured. It's an investment product. The fund aims to maintain a stable net asset value, or NAV, of exactly $1 per share. While it's incredibly rare, there have been historical moments where a fund's value dipped below $1, an event Wall Street calls breaking the buck. It happened during the financial crisis of 2008 when the Reserve Primary Fund held Lehman Brothers debt and suffered severe losses. To give you some historical context, the federal government actually stepped in back on September 19th, 2008 to temporarily guarantee money market funds to prevent a systemic run on the entire financial system. So while money market funds are exceptionally safe, they carry a microscopic layer of investment risk that a traditional bank account doesn't have. This brings us to the third option, which has become increasingly popular lately, the US Treasury Bill, or T-bills. T-bills are short-term debt obligations backed by the full faith and credit of the United States government. They carry maturities ranging from a few days up to 52 weeks, so short term. When you buy a T-bill, you purchase it at a discount from its face value. For example, you might pay $950 for a $1,000 T-bill. When the bill matures, the government pays you the full $1,000. That $50 difference is your interest. Because they're backed directly by the US government, T-bills are widely considered the safest credit asset on the planet. But the real secret weapon of T-bills is how they're taxed. The interest earned on Treasury bills is entirely exempt from state and local income taxes. So if you live in a high tax state like California, New York, or in other parts of the country with heavy local tax brackets, that exemption can save you a ton of money, making the effective yield significantly higher than a comparable bank account. It reminds me of a Jay-Z line from the track God Did from 2022 where he raps, "E was down 10 for this. We just got his 10 back, then went back like where the interest is." When you're dealing with serious capital, you always need to look at the math and ask where the real interest is after taxes take their cut. So, how do you decide where to park your capital? It all comes down to a simple balance of liquidity versus yield optimization. For your immediate emergency fund, the money you might need tonight if your car transmission blows out or your AC unit stops working in the middle of a hot Florida summer, keep that in a high yield savings account. You need instant, frictionless access without waiting for brokerage clearing cycles or bond maturities. For cash you're holding on the sidelines waiting to deploy into undervalued stocks or real estate opportunities over the next few months, a money market fund inside of your brokerage account is perfect. It keeps your buying power liquid and earning a strong yield right where your investments live. And if you have a known expense coming up in 6 to 12 months, like a property down payment or a tax bill, buy a ladder of Treasury bills. You lock in a guaranteed state tax-free yield while ensuring the cash matures exactly when you need it. Make sure you subscribe to the channel so you don't miss our upcoming deep dives into building generational wealth and achieving financial freedom. This has been John with Value and Mortar signing off.